Hi, Annie. Annie, are you there?
Be coached by Fauzia, I think probably like 21 very early. And I remember asking her about zero DT, and she's like, I don't tell anyone about it, but I trade it from time to time, you know? And that was like my first kind of like exposure to be like, okay, it's okay. I started looking into this more. And yeah, I really got into it. The thing I like about zero DT the most is that you get feedback every day. So it's actually a lot quicker to learn, even though the concepts may be more difficult. Because if you're trading 45 DTE, how you're using the mechanics and like learning around it, you just don't get as many reps to kind of like identify what is appropriate for you to do and such. So that's why I kind of cater towards that. And then are we recording this too, Fauzia? I think we are.
I'm recording it,
Oh, yeah,
and
perfect.
each one of the participants is also permitted to record it on their own computers.
Okay,
Is that
perfect.
okay with you?
Yeah, no, I
I'm
just
assuming, yeah.
like my main thing is I like to say I give away the secret to the implementation. So I just like to have people to have the information so they're best equipped to make decisions for what works for them and they don't make
Yeah.
boo-boos, you know?
What prompted
Interesting.
you to start with zero DTEs?
I mean, it's a track. The thing that got me into it is I had gotten burned trading individual underlyings, and trading individual underlyings can be tempting because the size of them is not as intimidating. However, I know Tasty Trade says be product agnostic, but in my opinion, individual equities are not actually priced appropriately from a short credit based side. I think it's not efficient, or the efficiency is like things being massively overpriced. But like a gold ETF, IWM, like all that stuff is efficiently priced. But the SPX with 0 DTE, anyone can do with 30 grand and like somewhat have responsible sizing. And the other thing with 0 DTE as well is like your position that you put on at 930 is more uncorrelated to your position that you put on at 230 than owning gold and the S&P is, or owning bonds in the S&P. So the ability to get that, like if you go to anything investing that's like be diversified, have liquidity, it's just like it all can be achieved in 0 DTE in such a smaller form, and you can learn it fast. Yeah. And also like there's automation now. So when I first started, I used to have to sit in front of my computer like an hour before the market and all day and not miss anything. And now you can like have the ability to live a normal life and not be in front of your computer as well. So I think that is even more reason why you should play 0 DT, because it's just everything that's apparent in trading options at longer durations. But the compounding, the time velocity of the money, honestly, I think the definability of risk is certainly better, but the black swan risk, that could kind of be up to you in your opinion. But it just has all the benefits and things we like about options to like a magnitude of prime. But if you also don't know what you're doing, you're going to amplify your mistakes to a magnitude of prime.
I'm hoping you'll give us an example, a specific example, maybe something related to, like, what is your basic when you said automated, does that mean you use bots?
Yeah, I use bots.
Okay.
So
what? I mean, so what is the excuse me, the basic process? I watched your video, but some of the photos were a little bit small. The screens were a bit small. So would you mind going over that?
Yeah, so I actually made, let me see, share my screen. I actually made a little portfolio for you guys. I just kind of assumed everyone would at least have 50 grand. Can you see my screen?
Yeah, and if you have a presentation, that works too. Yeah, go ahead.
I don't really have, I have presentations, but I feel like everyone could watch them on YouTube. So I was just working as a sounding board for what you guys want to talk about. But one thing I did make is I did kind of make a portfolio here of things I would trade for someone with like a 50 grand account. So, you guys can obviously ask questions, or we could go through this at a later point, but this is like one thing that I do, and I'm pure numbers based, quant based. So I don't really go on feel at all, just because the second you start going on feel, the second your emotions can help you outperform or underperform. But this was kind of the trade that I showed in the prior presentation. If you can see this trades every day for the last 8 years. It's had a positive expected return in every year except for 2018, which there are some problems in 2018. And then it's got a 20% premium capture, which is kind of what we'd anticipate getting. You can see some years it's better than others, but it only takes 5 grand of buying power. So if you were to run this in a one lot on a 50 grand account, you would have doubled your account value over the course of, basically 5-6 years, and you only use 10% of your net lick. So using this in a one lot, and it's also easy, even if you're not using a bot, because it's just at the market open. So as long as you're willing to allocate 15 minutes to jump on your phone when the market opens, you could run this trade and you could put in a stop and not have to worry about it for the rest of the day. So
sorry, Mark, I'm really dense here. Like, what are the actual legs?
The leg is a $1.25 call leg that is $50 wide credit spread. And then it's a $1.75 put leg that is 50 wide. And then they're managed each side separately.
Okay. So that's the premium for the shorts. Okay.
Correct. Okay. That's the target premium. And then what makes a big difference, and this kind of makes sense, is if the VIX opens up or down from the prior day, because basically overnight risk premium is extremely rich because the market is illiquid. So if the risk premium did not come out overnight, there's most likely people that are going to need to liquidate orders during the course of the morning. So therefore, there's a FaceTime audio misbalance in buyers and sellers. Therefore, you can sell risk premium and it yields a little more effectiveness to it. I don't use a huge amount of filters because I think that starts to be curve fitting. So like, for example, when the market gaps down more than 0.5%, the put side, kind of struggles, but it still does have a positive expectancy. So I'm still going to trade it, but you could probably increase your MAR a little bit if you wanted to do that, but I don't.
Do you put on the put and call side simultaneously?
You can enter in the order simultaneously, but I manage the legs separately to limit slippage. And also for reference, in the history of this trade, which is 1,800 trades, there's been 4 stop outs on both sides. So basically the cost of like closing out a leg for $10 plus commissions would actually drag on your P&L significantly. But basically think of once a year, you're going to get double stopped on this. And that just kind of happens. But it's very, very, very unprofitable. And if you think about it, these premiums will roughly be 5-ish delta at the open. So it's basically the probability of like a 2 standard deviation move off the open and then a reversal back to 2 standard deviation move.
Mark, real quick question. Was this week an example? Did you get double stopped at all this week with some of the big moves we've had, like on Tuesday or Wednesday?
Well, this is the beauty with 0DT is that new vol is now priced in. You know what I'm saying? So like, for example, I mean, this trade, the VIX has opened down every day except for Monday.
Right.
But, this trade probably would be 400 points wide with the volatility this week. Whereas if you were to put something on at a week ago or 2 weeks ago with where the VIX is and where the VIX is now, you'd be like $100. Well, I guess it reversed. So the rollers, you're good. But we could obviously see how that would have gone bad,
Okay.
This trade on Monday, granted the VIX was 65, was actually over almost 500 points wide. So almost 10%. Yeah. But that obviously never happened. Like the VIX is above 65, probably like 10 times in the last 30 years. But that kind of gives you an example of it. So this is roughly 5 deltas on each side. But with this trade, we obviously don't want to only trade this because it has a relatively large stop loss and it wouldn't give us diversification. So we want to build a portfolio of trades that actually have, a rule-based reason around it. So for example, the next trade I would do is like, I want something without a filter that I guaranteed can trade every day. And trade that I really like for that is, I don't think I actually said. So here's another pretty decent one. If you have a tiny account, I like this one for you. But basically, when volatility is low, selling 40 delta spreads at 245, which is basically coming in a power hour and then exiting before the market on close stuff, actually is pretty good. So this is this is anti-fragile. You actually don't use a stop. You're using the wings of the stop, and it's kind of like a fly. And this kind of makes sense because the cost to the commissions and fees are keeping really low. We can basically get through the time and get that rich decay through the end of day. And also you average about, $60 a lot on this, and it only takes $1,000 of buying power. So that's really attractive if you have a tiny, tiny, tiny account. So this is why I kind of wanted to show people this trade. This trade definitely don't size up though. This is like a one lot. So basically what I'm saying is, this trade can kind of get you 5% a year ish, but you're only using 2% of your buying power. So like that's very attractive to have this as a trade if you have a tiny account. And then you pair that with that open trade that takes 10% of your account if you had a 50 grand account, and then basically you could yield, 10% off of that too. So we're looking at, close to a 15% return with only, 7.5% of our buying power, which is really nice. The drawdowns, are fine if you size it right. Like if these were both a one lot on a 50 grand account, you're looking at, a 6 or 7% drawdown worst case, which is not bad. but these should be pretty uncorrelated because we have a 245 trade and a 930 trade. So again, if we have a big move during the day, the vol should be bid up. Therefore, the 245 trade should benefit for that. So this is kind of what I would refer to as like a quasi rolling of what people would do.
Annie has a question mark in the chat.
Oh,
would you mind?
Yeah. And then feel free to like talk to Annie if it's on you. You're doing 50 wide IC, but entering each leg separately. So entering each leg doesn't really matter because getting filled, you don't really pay a lot of slippage. So if you wanted to enter as a condor, you're more than welcome to. I would enter as 2 separate spreads just because you'll probably save $5 on it. The main principle is that you're going to want to, what was that? Is you're going to want to manage each side separately, because the thing is, if you're collecting, let's say you collect $1.50 on this, you're going to be buying back an order that's almost $600. So if you're shopping another leg of like 10 cents, you're probably going to eat, 20 to $25 slippage, which will almost nuke the trade. So these are kind of the things with 0DTE is like, you could get rid of your edge very quickly if you're not noticing it. And the other thing I would really encourage people to do as well is like subscribe to an options Omega so you can check your results. Because the thing is, you could trade this for a month and be like, I haven't made any money. I thought this would be good. And then you've just realized that instead of having, 20 cent slippage, you've now had 40 cent slippage, and all of a sudden you just lost your edge. So we have to take all of these with a grain of salt. And also when we back test, we always want to do 1 lots because we're compounding this over an 8-year period. So if you accidentally have like 10 cents better slippage, or you're using a 10 lot, you've all of a sudden magnified your mistakes by like tens of thousands of dollars. And you think you were going to be on a yacht and you can't even pay $100 a month now for your trading software because your trading's off.
Now, what is this package you referred to? Options? What was
Options
that?
Omega. So
what is that?
Basically, it has conglomerated every single option in the option chain price from every single minute since 2016 when SPX daily begun. So this is like, if you've ever watched Tom and them like talk about statistics, it's like this is more granular than their statistics for 0DT because I think they use top of minute data. So this has 60 more data points than their data does, which matters.
So it's a paid subscription?
Yeah, I think it's like $25 a month or something. So it's relatively, you could get into it and see it, but it's like if you're using leverage and you're trading and you can see the potential returns, it's like it's worth knowing that protection of what you're looking at,
Now, tell us a little bit about your hedge fund and I know you have to be a accredited investor, but what are the minimums?
Right now I'm just doing like 100 grand and then I have full liquidity. So anyone can withdraw their money at any point. There's no like lockup fee or whatever. And then I basically shoot for a 10% return every 90 days. So there's a benchmark that you can kind of hold myself accountable to. That's calculated off a 95% certainty. So I do get like 7% quarters or, stuff like that. And then I target around a 6% drawdown. It can vary a little bit. I touched a 7% drawdown for one day on Monday, but other than that, I'm pretty, I'm basically below that 95% of days. And then my main thing too is just income is outcome. And I'm just running these on a larger scale and through a much more quantitative approach, taking all of the back of the napkin, kind of like tasty trade principles and getting granulated to working them mathematically to as precise as humanly possible.
So if someone wanted to contact you, would you just put your email address there?
Yeah. And then if anyone wants to reach out to me in regards to just like normal things as well, like feel free to that. But
perfect.
I'll type it in the description here in a little bit. But yeah, you can reach me at Mark Anderson at mbhcapitalmanagement.com, or you can just go to the website. I have like links all there where you can find me and such. I'll listen here. I think we have another question.
Yeah.
When you use bots, do they help you exit a position at a specific time? Yeah, you can program bots so that you can exit positions whenever you want.
Now, Mark, this is Cole. This wouldn't work, or would this work in the XSP, or is it needs to, would that be too small?
The XSP, it would work, but the problem with XSP is the liquidity is not, it's getting better in all honesty, but yeah, the liquidity is relatively poor. Honestly, what I would give for my advice to people like this is like, so this trade, you're risking about $500 a day. So like, if that's too big of a hit on your account in a one lot, you should probably think about focusing more time on, doing something else than trading options, in all honesty. So like SPX is very attainable for sizing two people. Like it's more attainable than trading a naked option and 99% of stocks and underlyings. So that's what I would recommend. And like, it's just going to be more efficient because index vol is responsibly priced. And like, there's not a CEO that can screw something up, or like the government can't put the SPX under sanctions for a monopoly or anything.
Yeah.
So this is attainable for people that have accounts. All you need is 30 grand to avoid pattern day trading.
Good.
Does anyone have any questions particularly, or maybe some stories around like their SPX journeys or zero DT or things in general with other options I can speak to? I'm kind of more here to just answer anything you've got. And
Okay.
I'll share this portfolio with you guys also.
Sorry, Mark, when you started, did I see you say that you have a couple of different strategies that you employ? And if so, how do you choose, or are they restricted to different accounts? Did I see like a couple of different strategies in that list?
So I can kind of walk you guys through that. So basically, when we kind of look at this list, is like, okay, so first thing is like zero DT and open trades. So like we have our time diversification happening at the open. So this is good. And then we have our 245 trade. So this is more time diversification. Okay. And then if you look at the filters, we wouldn't want a filter that has this VIX condition on our 245 trade, because all of a sudden, the VIX only opens up or down half of the days. So we're getting less velocity of money, and we're basically double betting on the days where the VIX opens down. So we don't want to be doing that. So that's kind of how I started, is like we have different time frames, and then we also basically have no preference. We can trade this every single day of the week with the 245 trade versus the open trade where we're only trading half of the days. Then also this trade, is more capital efficient and, has no thought that goes into it. Like you don't have to worry about it. It's risk defined, and it's really, really capital efficient. And also this trade, it's like, these are, $1,000 wide max loss, and we do require a minimum premium of $4. So this trade risk to reward is, instead of 1 to 4, it's basically 1 to 1. So like we've mixed time diversification. Then we have a trade that trades half the days. We have a trade that trades every single day. And then we've also mixed our risk reward. So that's kind of how I would like to look at it. And then another thing I'll show you too, and it's just kind of like, okay, so you could use this test. This is a really big stop trade, but like that's an attractive PCR. You know what I'm saying? So this is just a EMA trade when the 5 minutes above the 40-minute coming into, the close here. You can basically take one that has a really big stop loss. So this one, I would definitely not do more than a one lot, because you could see, you could take losses of up to almost $1,000 with it. But this is like a concept that it's like, you've got delta exposure when this thing touches. So you're basically just playing the pure numbers on this one. You know what I'm saying? And then this is going to pair well with that 245 trade, because if we gap down a lot, that 245 trade will just already be passed along. So it won't matter to us. Or if we gap up on the 245 trade, on the call side, it gets challenged. This trade's going to pay off. And basically we've broken even on the 245 trade. So this would be the next one, is that if I'm going to put 2 trades within the relatively same time slot, I want to make sure that when those trades lose, they usually, don't really hurt each other. So obviously if we gap down massively, that's going to hurt this trade and the 245 trade. But this means the EMA may filter us out when it's gapping down. So we're probably going to miss out on, if we just say half the time the EMA is one direction, we're going to miss on half of those. And then if it gaps up, this is going to help us. So basically this is going to be 75% uncorrelated or 25% correlated to the 245 trade, even though it's in the same time slot. And then you can kind of see, now that you have these things going, the way I like to say it is, if any of you played sports, it's like practice is your back testing. The games is deciding which strategies you would like to deploy, and then the results is the scoreboard. So you can kind of think that the same way. It's like if we were playing basketball, we wouldn't want 5 people that are all 6 foot out on the court and could shoot, because we would just get dunked on the whole time. Even though it worked for the Warriors for a little bit, we do need someone that's like the Draymond Green Swiss Army knife on the team, if that kind of makes sense to you guys.
Mark, these times, are those Pacific? I'm assuming
they're all Eastern Standard. So I just
Eastern. Okay.
Yeah, I all talk in Eastern. So everything's
Okay.
Eastern. Yeah.
Okay.
Mark, is any of this ever calendarized, or is the long option always in the 0 as well?
So the long option is always in the 0.
Okay.
It'd be significantly more uncapital efficient to not do it that way.
Okay.
I did make some calendars for you guys. I do like these calendars because the point of calendars, and this is another thing I kind of like to challenge people with 0DT, is like 0DT doesn't just mean options that are happening on the day of expiration. I kind of refer to 0DT as options which can be placed every day. So like you could trade a 1DT option and still place it every day of the week, which is kind of the benefit of 0DT. But the caveat to that would be that you have some type of defined overnight risk. So for example, with calendars, obviously, these durationally are not 0DT, but we can put them on basically every day of the week, and we kind of know what our risk is overnight. So I recommended this to you guys as well, because you can see here kind of that like the average debit is roughly $2,000, and the average return, per occurrence is, about $100. So this is definitely something that you can run, on a day-to-day basis and not hurt your account that much. So this account that we're going over, like if you guys were to run it and your execution was good, you could basically do like 30-ish% with a 10% drawdown, which is great. And you could have a bot do it for you. You know what I'm saying? And on top of that, this is all 1256 tax advantage. So you're going to pay half as much taxes as you normally would. So like if you're living in California and you did, actually California doesn't recognize long-term capital gains. If you're living in New York and you were doing this, you'd be paying as much taxes as someone trading non-SPX options in Nevada or Florida or a state that doesn't tax you. California is going to tax you though. So this is a good one. I can explain some more stuff. I don't know if you guys have any more particular questions. I haven't seen anything in the chat.
Well, I'm asking another uninformed, showing how uninformed I am. Do you design your own bots, or do you just pick them up from the marketplace?
They're all templates. I would say that the market has kind of adapted to backtesting software, so it's somewhat rudimentary to do it. Okay. I don't really have a problem with people like using strategies, but I would see the main problem is people are either back testing poorly, so they have a much rosier picture of what's going on, or they like are poor at like making their bots. So for example, it's like in 0DT, you could trigger off of a double bid or a mid price. So it's like you could easily double your slippage using the double bid, which would basically half your returns. The example I would give, it's like if you're trying to lose weight and you weigh yourself once a month, you're probably going to struggle to lose weight because you don't know where your progress is. But if you're weighing yourself daily, it's going to be a lot easier to correct and not get off course and be able to succeed.
Mhm.
Oh,
So the 2/4 calendar is
yeah, Mondays,
Mondays, every Monday.
every Monday. Yep.
Okay.
And then you can see we've kind of beat this up because it requires 2 profit takes. We cap the profits at the top of the minute, and then we have slippage coming in and fees and everything. Then we have an early exit, and I'll send these to people afterwards. And then on Tasty Trade, they just did release some bot integrations with them, so they're pretty good. I personally prefer interactive for bots. Like Tasty Trade's great because it's a little more gamified and easier to use UX UI wise. But in terms of like Tasty Trade's ability to have APIs and bots that execute orders come into it, it's a little more rudimentary in that sense, just because it's more catered towards retail traders, which is fine when you're looking at stuff. But if you want to not like, if you want a bot to trade view, I would recommend interactive.
But most of what you've talked about applies to retail traders. Have you talked to Dr. Data about this?
Yeah, I mean, it applies to retail traders. Just what I imagine is like the liability and cost to allow APIs to integrate on your platform is probably somewhat capital intensive. But also I wouldn't have bots be like a stop to you. So like if we just looked at what I showed you, if you could allocate 15 minutes at the market open and then half an hour in the afternoon, you could execute all of this manually because you can still have resting stops at Tasty Trade and everything. And even though that's not efficient, I think it's good to not be efficient at the beginning because you'll learn and feel what the positions look like and behave when you're doing it manually. So I used to trade completely manually. I don't anymore because I focus more time on testing and data. But how I recognized all these patterns and grew confidence in trading these was through actually manually trading them.
How long did it
When did
take
that
before
take to-
you, sorry, go ahead.
I was going to say,
No,
how
go-
long did that kind of take when you transferred from you were comfortable to just step away and have the bot take over? What was it, 1 day, 1 month, 1 year? You know,
I mean, I traded discretionarily a lot and sizing was kind of weird. And the thing is, it's like I made a bunch of money doing it, but I started to get to the point where like losing 10% was a big number, which affected me different emotionally. So it's kind of like you decide to be a man instead of a boy. It's like, I'm not going to put up with this stuff anymore. So it's like, it's kind of a maturity thing of when you want to do it. And the analogy that I kind of give to people as well is it's like, you're not going to teach someone that's 7 foot how to play basketball the same way you're going to teach someone that's 6 foot. So I wasn't trying to be a talented trader. Like the thing is, there's a bunch of people on groups and whatever that are doing it. And it's like, we're all championing people who like are really good at making decisions under stress or maybe lucky. Like I'm sure some people were worried about the yen and took off Friday. You know what I'm saying? And it's like, I traded Friday and because I modeled and tested corrected, I was 4 times leveraged in SPX and took a 1% drawdown and I was short options, but that's kind of like a testament to it. So what I'm trying to iterate to more people is there's all these courses where people are like looking at volume bars or they're rolling, which could be a huge amount of risk. Like depending on like, if you were to test it, like you always rolled except for like, but somehow people miss like the percent of times when something happens. Whereas what I'm trying to show you is like stuff that works. It's like I said, 30% with a 10% drawdown with an account that's as small as 50 grand. Like I think people can do that. I tried to do like 60% with a 6% drawdown. And the leap between those two is like tens of thousands of hours. And you like may not even be capable of doing it mentally or, you know, that type of like load on your mind. So I'm trying to pitch like what works and is easy for everyone that can be attainable in a time frame that's like an hour a day. And if you use bots, I think you could do it in like less than, you know, an hour a week potentially. And then does anyone have any questions that what you're currently trading, or is anyone afraid of options or SPX? So like one thing I can also do is I've done a lot of like personal development and Tony Robbins stuff, and I'm starting to be a crew and a captain. So it's like we can do some mental side of trading if you guys want to chat about that as well, because I think people like it that probably gets in a lot more people's way than anything else.
Yes, please go ahead.
Did you have something, Mike? I saw you came off mute for a second.
Yeah, sorry if I can interrupt there. I'm sorry I'm late there and got a bit messed up. I was driving. When you said you used interactive brokers for your bots, is it their bot that you're using, or a third
So
party?
there's several options with interactive brokers. I use an iteration of Trade Automation Toolbox, personally, what I do. So anyone can look that up online and subscribe to it. They do also have something that's called IBPI, which is basically their API that people can code and be native on. And then there's also TradeMate IO, which you can basically send your orders to be executed by bots via Telegram, which is also really cool. So there's multiple preferences that you can do in regards to that. And if you were like super advanced and you wanted to build something custom, they also have a marketplace with a bunch of people that are experienced building automations that you could basically hire to help you out with that as well. Or you can do it manually if you have the time and it's not inconvenient for you as well.
Sorry, just quickly again. I mean, I think they have something called iBot, interactive brokers. That is.
Yep.
So have you tried that, or is that just some kind of Mickey Mouse?
I think that's a little more Mickey Mouse. I mean, everyone that's really executing stuff is either building their own or using, 2 or 3 of the larger conglomerates that are offering it. I kind of find that the free market is a little more adaptable and quick to provide any quality than the native platform for all of that. So that's kind of what I would do. I would say the most useful thing on interactive, it's like if you want to look at your risk graphs or model, they have all of that stuff within there. But yeah, I would just recommend subscribing to these bots. But the thing is, it's like, again, it's not a huge deal. If you're better off getting the back testing software than the bots. I don't want people to overhype it that much. And like some people, you may mentally struggle with it. So I would just say start doing it manually. When you get more comfortable with it, you could transition to the bots.
Okay, thanks. Yeah, because I work all day and I've been trying to zero DTs and doing not too badly. It's just I found it's so time consuming.
Yeah, you sound like a perfect use case for bots. Yeah.
Yeah, this can get me away from it, and if this can save me time, then obviously it makes sense. But thanks.
Yeah, of course.
Mark, if you had to choose the first strategy that so I've done them on and off, like I said, but not with any sort of regularity and not with any sense of purpose. Like I want to make this my mainstay, but I get a lot of questions about it, and I would like to explore it. Is there one single strategy out of these 5 or 6 that you discussed with us that you would ask someone to start with and stick with?
Yeah, I think that this all in at the open one I really like for people to be trading.
Okay.
The only downside of this is you do have to check is the VIX up or down, but
okay,
this is like very attainable for people. It can, like, you can take a few losses in a row, which can hurt. Like you could lose, $2,000 in a week, which can be mentally hurtful to some people, but it's
difficult.
Like the vol always kind of comes back. And
Yeah.
then if you have a really small account, and this is also like what works for you. So 9:32, if you're in California, this may not be a trade that you like because you don't want to wake up at 6:30. So you have to also do what's for you. Whereas like this 245 trade, is maybe great for someone that is in California. You know what I'm saying? So it's not whichever one it is, it's the one you stick to. It's like same thing as working out. None of these strategies are right. The problem is you not executing it, because the edge is tiny in 0DT. I actually think it's significantly smaller than in any other duration, but the benefit you get from the daily compounding is 100, and no overnight risk is like 100 times better than any other option you'll trade. So even though there's like 20% as much edge in a 45 DT option, you can do it 100 more times, and you can define what your worst case is, so you could use more leverage.
Mark, when you say execute, do you mean just continue to do it every single day? Is that what you mean?
Yeah,
Like not
so
giving
like,
up when you get kicked in the teeth type thing?
yeah. So if we were to, then this will be an example too. So if you look at this 245 trade, so we can see here that like, you know, average winner 199, average loser 212. So this trade, like if you skip a day, it's not really going to matter. You know, it's got a really neutral risk to reward. The only problem with that is like if you're only executing this trade 2 days a week, 3 days a week,
Yeah.
Or you're under the hallucination that you can guess this, it's like this is basically a coin flip. So like if you want to guess, like go, you know, this isn't a trade to guess. So this is kind of like the two parts of it. It's like this trade, if you miss it, you're not going to miss out on, you're not going to avoid a big loss, and you're not going to get the big win. So it's not really going to affect your long-term expected return. But the thing is with this is like, this is, the wins are really small and the probability is really small. So if you start trying to like guess it and you're missing days, like you're just going to give up that compounding, which is the entire benefit of 0DT. So like these are some concepts. It's like we want to benefit from 0DT, the compounding of it. But if we start choosing directions and we're using a trade that has a super, super low stop and like basically a 50-50 risk to reward, it's like the reason we made this trade and the reason it works, you're completely acting against. However, if we were to look at this open trade, this has got a relatively big loss multiple. The loss is, you know, 4 times larger than the average win. So the thing is with this one is it's like, if you miss the day when it wins, okay, that's not going to make a huge difference. But if you miss the day when it lost, that can make a huge difference. Or if you only traded 2 of the days when it lost and then you got scared. So these different trades have different problems. And the main advice I would give to people, it's like, if you have 50 grand, it's like, you should either just say, I'm going to execute this, and mentally, I don't care if I lose 2 grand because I know this is tested in the good numbers. Or you should just say, I'm going to go make more money working and spend my 50 grand on training to like figure out what I'm going to do. But if you had more capital than that, I would just say run this at a size that it's so trivial you wouldn't even care about it. You know, this is like ordering, you know, like a 2 things of sauce at a restaurant and you only got 1. It's like, you're not going to be mad. It costs like 25 cents that they extra charge you for or something, you know. That would kind of be what I recommend to it. But the problem with most of these is that even though this is a test and like I've sold like $30 million in 0DT premium, and like I make $1 million a year trading these options. So it's like, clearly I'm credible, but you didn't test this. So when it starts to like not go well a couple of days in a row, you may give up because you didn't do all the work. Like the Latin word confidence comes from proof to oneself of capability. So these are kind of the problems why everyone's messing up with options. But I do think that 0DT is easier because you could automate it and you get to play again tomorrow. So when we take a, you know, 5% or 10% drawdown 0DT, that may take like 2 or 3 weeks to get back from. Whereas if you're trading 45-day options, you may be in an inverted strangle for 6 weeks.
Yes.
Yeah. So
Yes.
like these are all the mental quirks and things around it. And it's like, I'm not here to be like some big pharma company that's like tank painkillers and trade 0DT. It's just like, is this something you want? Is this something that works with your lifestyle? And then it's like, if you have decided that that is, you should like treat this as a fitness challenge. It's like, I'm going to do this for 90 days as a robot, and then like check it to my back test and then make the decision. Whereas I think a lot of people may be like, ooh, well, I have to spend $40 a month on back testing software and $70 a month on, you know, automation. And you're like, if I'm trading one lot, like I may only make $100 a month. Is this worth it? And it's like, in everything in life, you have to do more than what you get paid for to get paid more for what you do for. So like I started trading with a $40,000 401k rollover. You know what I'm saying? And like I treated it like it was important and like, hey, if I could do this with 40K, I could do this with 5 million. And I'm doing that now because that was what I said in the very beginning. Not saying that everyone needs to open a hedge fund, but the fact isn't that, you know, it makes sense financially to spend, you know, $150 a month and 10 hours on doing this. It's the fact that if you can do this and you can make 30%, you can retire in 10 years with your current 50 grand account right now. You know what I'm saying? So like, that's what you have to understand. And that's kind of like a seriousness that you need to look at if you want to do this, because you're going to get what you get put out into it. And this is like part of it that a lot of people don't see. It's like, it's the follow through of it, you know? And the other thing that I see with a lot of people is they'll be like, hey, I've been trading options for 20 years. And if you don't have a really big account and you are successful, that almost tells me that you're just still learning the same lesson for like the 50th time. Because like, if you were really good at trading options and you've been doing it for 20 years, you'd like be on a yacht or you'd be like running a fund. You know what I'm saying? Like you wouldn't still be meddling around with your $200,000 401k trading options. So these are the things we need to decide of what we want to do. And the biggest thing with all of this is like clarity. So you've kind of written yourself a mission statement of what your goal is, whether that be 45 DT strangles, whether that be whatever it is. And then it's like, now that you have your guardrails of where you're staying in, you pay attention to everything in it. And like, you don't jump off to look at something else. Nope, I think we have some questions here. Talk to tech support and Scott takes straight after conditional orders. An order that would close at 25% profit. If that doesn't hit, hard to close the position 1 hour before the close. I mean, if you're an SPX, that's not true. There's so much liquidity and ability to close these things. It's like ludicrous. So I would say that in individual underlyings, that could be the problem. But just for example, it's like there's more notional trading in SPX on one day than the history of all transactions of every single crypto that's ever occurred in human history. And the first hour and the last hour are actually the most liquid times of day. I would say in the last 5 to 10 minutes, yeah, it's not great, but 99% of the times your positions are so far away in the last 5 minutes that it'd have to be like a 10 sigma move to touch.
I have a quick question, just like really basic mechanical talk on this. So it's a $50 wide iron condor open at the open. And I know you say you have a stop loss 400%. I actually have never really traded with stop losses. I've generally traded more the way Tasty Trade is like, oh, put it in your GTC at, you know, pick your percent. Do you just let these ride to the close, or are you looking to actually close them before?
I look to ride to the close. So again, if we look at this, so like our average expected return per trade is $28. So if we were to buy back the option at 5 cents, that would cost us basically $6. And this has 2 legs. So we just went from making 50 grand to 25 grand to close out our order. So in 0DTE, like the part of the benefit, if we think about it, so it's like implied volatility is overstated, that's basically proven. But the concept we need to understand is the money we make is implied volatility minus realized volatility minus commission slippage and fees. So you've just doubled one of the parts in the formula that relates to how much money you make. So we want to avoid that as much as possible. So part of the reason I actually choose Forex is that means the position is very, very likely to actually be in danger of like going in the money.
Okay. And from a technical standpoint, you're basically looking for you're selling a call at whatever gives you $1.25 in premium. Is that what these notes mean?
The closest to $1.25.
Okay.
The other concept I kind of like to show with this is we all know the put side is richer in volatility.
Right.
So like I would actually call this a delta neutral strangle. Whereas a lot of people will trade a 16 delta on both sides. And it's like, you're short 16 delta. Like I hate on the call side, like the 16 delta puts just further away. So like if the market moves at $10, all of a sudden you're short the market. You're not short vol, you're short the market.
Okay.
So even though this is why I chose the credit, not the delta, even though they'd be relatively similar, because by doing this, we're taking the same risk every single day. So if the VIX is at 13 or if the VIX is at 30, as long as we win 80% of the time, which is like the break-even rate, we're going to make money on this trade. Whereas if we were to collect 4 times the credit when the VIX was 65, if that one just so happened to lose, it could wipe out 2 weeks of profit for us. So by using a credit as a target, and then by actually, like, we know the puts are richer, I've tested it, like the call premium capture is like 10%, which is if we sell $1 premium, we keep 10 cents of it. And the put premium capture is 30%. So if we sell, $1 of put premium, we keep 30 cents of it. So this is a delta neutral strangle from a credit and risk perspective because the puts trade better. But yeah, closing it out, we want to avoid doing that unless it's at our stop, because we're in turn going to pay more commissions, which prevents us from realizing our P&L.
Gotcha. Okay.
So Mark, if one side goes all the way in the money, you just let it expire and
It'll be cash settled.
it's cash settled. But
Yeah.
there's a fee for assignment, isn't there? Or not with SPX? It's all cash settled.
Yeah, there's not a fee for assignment.
Oh, okay. Are you ever tempted to roll up the other side at all?
Yeah, I think rolling up is actually fine in regards to this, but you are eating those commissions, so it still kind of brings a problem with this.
Yes.
Whereas we could talk about this more, but I would say the better thing in terms of rolling would be like, let's say you traded this at 9:30. And then at 10:45, you traded the $1.75 combination, but you flipped either the put or the call side, let's say. So like if your call was getting challenged, you'd sell $1.75 put, $1.25 call. If your put was getting challenged, you'd sell $1.75 call, $1.25 put. So this is a little bit different way of thinking, but by paying, because the thing is, it's like if your call is getting challenged, you're probably at like a 2 delta on the put side. So you're still paying, you're still, giving up half of your expected return over a long period of time to roll that up. Whereas even though you're using more buying power when you're doing that, you're not paying as much commissions. And the thing is with 0DT is leverage is so cheap because you can buy that wing that you should never, if you're sizing responsibly, you should never have a problem with buying power.
Right.
Yeah.
So would you think about just adding it, since it's only for just for the next couple of hours, letting the one that's completely out of the money, not closing it out, but then selling another one, let's say in this case, another put spread. Obviously now you're deploying more buying power, but it's for a very short amount of time. Do you ever do that?
Yeah, I have some indicators that deploy it personally. Like, I think that buying options is a better way. Like, you do have to have a larger account, but a long option offers you convexity. So if you were getting challenged on the call side, let's say you're at a 2x stop, and then I bought a call. So for like, $100, I could buy a call that could hedge away like $5,000 of risk or something. You know what I'm saying? So I would prefer to kind of do that because the thing is, it's like even long options, especially on the call side, actually have basically a slightly positive expectancy if there's no stop loss. So if you're buying an option and you have no profit take, it has a positive expected return on the call side.
So you're buying the buying the call beyond the short call spread that's being challenged or has been
No, I'll buy it before. So like,
before. Okay.
yeah, because let's say that call spread's still like $20 out of the money. If I
Right.
buy like an at the money call, I mean, you have to be.
Oh, it's out. It's not. It hasn't been breached yet. It's still out of the
Yeah,
money.
because the
Okay.
stop is your like big fast move thing, but like
Right.
I wouldn't really recommend people do that don't have super big accounts or can stare at the market all day.
Right.
But if you wanted to like take a lotto on like XSP in a one lot, that's fine. You know, you should have fun trading too, as long as you keep it to less than like 10% of your allocation. Um, but yeah, you could do that because like if you're buying something, XSP could work. You just don't want to be selling credit spreads that much in XSP because the slippage is going to be bad, which will kind of ruin your expected return.
And it's not cash settled, is it? XSP?
No, XSP is,
It
and
is cash
XSP has
settled.
no
Okay.
commissions or
Okay.
fees.
Oh,
So
okay.
XSP is free. You can trade
Okay.
for free XSP. Going back to that note, so one other thing I also got you challenging the zero DT thing. I mean, so zero DT to me means something you can put on in more duration. So for those of you, this is a 50 wide spread. You can put it on once a week and it yields $40 or a 10 basis point return on $5,000 of buying power. And you can see it's worked very well since 2016. So this is kind of like my version of a 45 data expiration put spread, but you can do it on a 7-day duration. So just basically every Friday, you throw this on at the open, and then you just have a 5x stop loss or hold it to expiration.
Oh, it's a nice one. Yeah.
Yeah. So this is like 45 DT stuff. And like your roll on this is just your opening next Friday. That's your roll. You know what I'm saying? So like it expires or you roll it on Friday. So I think mentally, a lot of people can grasp this, and like this is something you can trade that takes 10 minutes once a week. So you don't need to automate this. You don't need to do this. You don't even need a $25,000 account because you're only putting this on once a week. So anyone can trade this with like $6,000 in their account, and you can see it's pretty good.
And just the put side.
Yep, because we got that rich skew. And then if you like, so the reason we want to get, I forget what that segment on Tasty Trade's called when they bring in the math people, but
the geeks option,
yeah.
Options Drive, or the one with the guy in California who goes to Burning Man, that guy.
Yeah, so you can pretend I'm the guy in California that goes to Burning Man, but basically the reason why this works, and you can actually look this up on academic articles if you were to search it online. There's something called the weekend effect. So basically dealers or the other people on the side of the market making firms, they are basically pausing theta decay to a certain extent over the weekend to best preserve their risk in their books. And it's a liquid, so they obviously know there's going to be no demand for liquidity because you can't trade over the weekend. So it's a very observed phenomenon that there's a clear large edge of understatement of volatility over the weekends. However, that means that when volatility does move, it moves so much larger than has ever appeared would be the case, especially comparative to days when the market opens the next day at 9:30. We saw that this week on Monday with the VIX spike. But by having this as a risk-defined trade with only being $50 wide and being very, very far out of the money, we basically have created a situation where we can take advantage of that massive beta decay. And even though we're paying a lot of money for that long leg as opposed to a naked thing, the dealers have basically said there's not aggregate demand for this theta, so we'll sell it for a richer price. So this right here is an amazing strategy. To give you an example, the MAR, which is the max drawdown versus the compounded annual growth rate, in the SPX is like 0.4. So holding long index and like the Qs or whatever that is, this is about twice as risk efficient and about 5 times more capital efficient. So this, like, again, we go back to that 30% portfolio. So like what I would recommend for people to do is you could buy the ETF. It's called RSSB, which is return stacked stocks and bonds. They basically buy futures, S&P futures, and then bond futures while holding iShares S&P 500 and iShares aggregate bond index. So for $1 in that ETF, you get $1 of exposure to SPY and you get $1 of exposure to AGG. So you basically, if you had a 50 grand account, you could buy 25 grand of that. You have your traditional 60-40 stock bond portfolio that everyone has in 401k. And then on top of that, you could run a one lot of this and basically get 5% a year on this for 5 grand of buying power. And then all of a sudden you have 20 grand more buying power to trade options. You created an uncorrelated return through options premium with this. And then you've also used the leverage of complex futures algorithms and derivatives that you pay 60 basis points a year in expense ratio for someone on Wall Street to, behave and run for you. And it's like, it's so easy to beat the market. It's like actually not that difficult. It's just people's ability to think around it. Because the thing is, it's like, if you're using leverage, which we're doing with options or we're doing with that RSSB ETF, you should be able to beat the market no problem. Risk adjusted, you may not unless you start to think a little bit, but we clearly know that a trade that only goes on Fridays. So if the market were to crash at a certain time and it is a 2 standard deviation move with the weekend effect, this is not going to be that correlated to the overall market. You know what I'm saying? And like, it's definitely not going to be correlated to bonds.
What is that ticker symbol again, please? RS?
RSSB. You can
B
also
as in Bombay?
boy. Yeah.
Okay, boy.
R as in
Okay.
Roger, S as in Sally, S as in Sally, B as in
Okay.
Brian. Yeah.
And this strategy is based not on premium, but only on 7 delta or a very low delta.
Because we want that probability of something going boom on this. You know what I'm saying? We want to be at that 2 standard deviation. So like if you put this on tomorrow, you're going to be far. You're probably going to be below 5,000.
Very
Maybe
nice.
a little gun shy after last week, but probability wise, this week's probably a great time to start this trade, because we just had the boom. So people are probably willing to pay people a lot to hold risk over the weekend.
I think we're all going to do it. At least I'm going to do it. I'm going to be very, so should I commit myself to 3 months of very considered? Do
we see the problem with this? You're asking me, you know what I'm saying?
I'm asking you.
This is a commitment to yourself. You should be asking yourself in the mirror, it's like, do you feel confident in this? Like, do you, are you willing to check it weekly and log, you know what I'm saying?
Oh, yeah. I'm in front of the computer every day for a variety of other reasons, but this seems like a great place for me personally to start. What I meant by asking that question is 3 months of, I promise to be very, committed and dedicated and watchful in the sense of, bearing the losses when they occur and doing it every Friday. Is 3 months, would you as a friend say to me when I cry and go, oh my gosh, I just lost, and you go, just hang in there for 3 months. Is that what you would say? Okay.
I would say this is great. And then I would say if you size this at like no more than like 5% of your buying power, I think is responsible for lot size to start.
Okay.
So if you had 100 grand, you do a 1 lot. Again, if you're in a 50 grand account, you need to make money. So just do it in 1 lot. And you could do this in a 25 grand account too, but this trade, like it's gonna work on a short-term basis. The other thing statistically I want to point out with people is when we're trading a 5 delta, we know we're going to have 90-ish% rate of success.
Mm-hmm.
So just statistically, if you flip a coin with a 50-50 shot, you can get 9 heads out of 10 flips because statistically a 50-50 shot, you can lean on one end. However, with a 90% probability of win, it's very unlikely you would get like 8 in a row or something. It's almost statistically impossible. So this in 90 days, like I will sit down with you for an hour and teach you options if you did this every week for 90 days and you didn't make money.
Okay,
Yeah.
excellent. So this is when did you start this? This is
2016. So this is 8 years of data. It
Okay.
lost money in 2018.
Okay.
If I looked at the trade log, I bet you there was like 2 terrible gaps over the weekend.
Right.
I was like 21 in 2018, so I don't really remember what was going on then. I wasn't really trading, but you can even see like in 2020 it made money,
Mhm.
and then so it's made money in 7 of the last 8 years, and I think this is all like something crazy happened in 2018.
So those
So
are
like this
cumulative trades, 389 Fridays and
389 Fridays.
355. That's excellent. Yeah.
Yeah.
Considering you went through 2020 with it.
Yeah. And then look at 2022, you did 41 basis. This is not $1 million account at one lot. That's just how I test. But it did 41 basis points in 2022. The market was down 22% or whatever it was. And your biggest drawdown was 29 basis points.
Yeah.
That's pretty good.
It's very good.
I tried to invite, I mean, I did invite Tom to come join us, Sosnoff, and he was going to, but then he got called away. So he just texted me and he said, gotta get that guy. And I said, yeah, I told you about this 2 months ago.
I wish he was around. I actually have their bobbleheads on my desk. I bought his beret. I tried to wear it for a little bit. It just wasn't for me though.
Yeah, no, he will. He'll definitely call you on the show, and too bad you can't go to Mexico City, but that's okay. That'll probably be a huge gala with all the who's who of Mexico. I heard that Nassim Taleb is going to be there. So they have some pretty big heavy hitters. But no, Tom will call you and we'll try, if you don't mind, we'll do another one when Tom can commit, because he committed today. And then I was going to be my surprise guest. But he said he could join us but an hour later, and I didn't really want to disturb everybody else, so I had to say no, sorry, Tom. But we'll schedule it again if that's okay with you.
Yeah, of course. I just love chatting options. And I know it can also be kind of lonely out there for those option traders. So it's always nice to chat with people and then bounce ideas off each other. Like what I like to say is I've made a lot of mistakes in my life, but imagine if you were simultaneously making mistakes with 3 other people that were making mistakes and you told each other's mistakes. It'd be like you could make 4 years of mistakes within 1 year and you only have to make 1 out of 4 mistakes, you know?
Very well.
So that's ultimately like the real goal of everything here. And like, I also just want to say it's like, you guys can all do this. It's like, I know I may sound all mystified and this maybe go over your head, but it's like, I was a construction worker and I signed up to be coached by Fauzia, and like, I had no idea, like I was nervous and like, I didn't really know how to trade options, and naked options scared me, and inverting strangles scared me. And like everyone thought I was an idiot by telling people, I was going to trade options and do this. And it's like, I'm here now. Like it wasn't a linear progression, but when we're going up and down like this, we have to remember when we get in the trough, we're a lot higher up than our trough down here,
Well, I'm so proud of you, Mark. That's wonderful. This is a wonderful story. Maybe you'll be writing a book or a blog one of these days, and we'll get to read it. This is an excellent story. Are there any other questions? I know we've gone over our time.
Yeah, I got just a quick one there, Mark. So
yeah,
some of us are like older. So you had mentioned earlier that, in 10 years you can make this money, but, some of us might not be around. So having said that, and I see you have quite a variety of zero DTE strategies. So you're obviously deploying different ones every day by the looks of it. Am I correct? Because I might have missed at the beginning, that sort of thing.
Yeah.
Okay. So which one is your favorite? I missed that. Is that the SPX zero DT with the plus the 50 50-point spread? Was that
I mean, what's different for me is different for you. So it's like, I kind of ask like, what are you going for? Are you going for income or like where do you live, what personality fits you. Is like my favorite is Power Hour because it's like I just rather be like worried about my positions for an hour. And then I know if I won or lost 100 grand, you know what I'm saying? Whereas like, if I'm like at the gym while like positions are on, I like can't think about it that much. Or like if a bunch of stuff's happening overnight and I'm like hanging out with my girlfriend, I can't like be present for her. So these are all like lifestyle things, but it's like, yeah, I like Power Hour because it's like you just get on for the ride and like you can lose in 10 minutes and get on with your day, or you just kind of know if you're good within half an hour and then you can go on about it. So that's personally what I trade. I got really into it because I was on the West Coast. I was in San Francisco and it just worked conveniently for me. So I was like, I'm going to trade this time slot. I know a guy that I trade with that lives in Hawaii. He only trades Power Hour because he's upset I'm going to wake up at 4 a.m. That's not going to work for him. But I would say for you, like it depends on your account. What I would actually do is like run all of these. So like the Friday one's nice because it's like all week exposure. You'll basically know if you're safe by Tuesday. The Monday calendar is nice because you don't have the weekend exposure and you'll be off by Wednesday. And then, you know, either the open or the afternoon trade is nice because you only have to log on once in a day. And like that gives you diversity. So the concept of like, I could give you real advice is the vast benefit of diversity comes from 1 to 2. Like that's a huge amount of benefit from diversity. Whereas there's almost like statistically 0 benefit from diversity going from 8 to 9, you know? So I would say if you pick 2, like if you picked 4, and the 4 were like I was saying, like this one trades every day of the week. This one only 25% of the time. If it straight crashes, we'd have exposure. And then you have one trade that takes overnight decay, which would be like this Friday one of the calendar. Like you would be sitting real good and pretty. And it's like, if you ran those 4 trades at one lot, like you should be making $300 a month doing that. You know what I'm saying? And like, that's pretty good. And that's only using like 15% of your buying power. If you had a 15 grand account, maybe 20.
Mark, would you go back to the Power Hour if you don't mind really fast? So can we get a copy of this or is it
what I'll
we
do?
have the recording. We have the
recording. You'll have the recording, and then I can also like not everyone will have option Omega. So I think if you just go through the recording and see these will probably be just the easiest way to do it. You can email me or respond to the email. I think we're all on it, or I can send a picture of it.
Okay.
But yeah, the recording is probably the best because I'll explain it. So here's the Power Hour one. It's just the EMA. So the minutes are above. This is trend. Honestly, this barely improves the results. So you could just kind of trade this every day as well if you wanted to do that. And also going back to this is like people will look at these back tests, but if we want to get really into the weeds, the reason Power Hour is good, especially on the put side, is that dealers need to report their risk to their clearinghouse at 2:45 each day. And they need to basically kind of maintain this risk through the close of the day. And then large funds like State Street and whatever place market on close orders for retirement funds and whatever. So basically between 2:45 and 3:45, they kind of got to hedge out the risk before the market close. So there's an aggregate demand imbalance of sellers to buyers, and then there's margin requirements. So regardless of option pricing formula, more people will need to close out their orders at end of day because they don't want overnight exposure and they don't have the margin to hold those overnight. So there is a lack of sellers at end of day. So you are therefore compensated more for that. For that to be even amplified more so, skew, which is prevalent on the put side, which is why we like selling puts, is artificially heightened towards expiration. So if we have a bell curve of where the option price could go, that bell curve squeezes faster by the minute. Therefore, if we didn't move, you're at a much further delta. And then we also know that out of the money options expire faster than at the money options. So in the same amount of decay, assuming all variables the same, price, all that stuff, the at the money 50 delta option will decay, 43% over 50% of the life of an option. The 15 delta option will decay like 66%, and the 5 delta option will decay like 85%. So we're going to get the benefit from that skew falling off a cliff much quicker and more into power hour. So this is also kind of like why I feel more confident in this is it's like, okay, this is just going to work. And also like, if you were to test this with, it works in a low VIX, it works in the high VIX, but the higher the VIX goes, the better this works because skew is even more heightened towards expiration. So we're basically like, there's basically an environment in power hour where the market demand has created a higher volatility environment in terms of skew. It's not drastic, but it's more than any time of the day.
What do you mean by 130, 230 open trade?
So this is a 2 entry slot. So why I included this is that they both have relatively the same expected return. However, if you only did 130, it's only going to trigger half the days. But if we do 130 and 230, we can almost get it on every day. And if it doesn't, it's probably a very good indicator that we shouldn't be selling puts that day. And then you can also like, this is where I would kind of like, again, I'm mathematical, I go by the data, but I would say like, this is where you can be discretionary within a mechanical portfolio. So let's say you put it on the 130 and it ripped up and then the EMA is still there at 230. You could be like, well, I'll put a second one on today. You know what I'm saying? Or if you're like, ooh, the market's looking really down and it didn't take the 130 trade, I'm skipping the 230 trade just because it doesn't look good. So that's kind of like ways I like to think about it. But I would say that, you know, most of your trades, you're just never really going to touch in regards to that.
Wow, this was great. Thank you for your time, Mark. Does anyone, we should let him go. Does anyone have any other questions?
Yeah, I got about another hour or two of questions, but
I'm actually in not a rush, so I'm
Okay,
more than
okay,
happy to
alright.
keep ripping questions while I'm
That's
here.
fine.
Like,
That's okay.
I'm sure you guys put in the work to take notes and do whatever. So it's like I'm a wealth of knowledge, and there's no point in keeping it up here.
Well, thank you very much. This is really interesting and definitely gives good ideas for what we can try out.
And we should definitely try to get him back again, maybe after we've all tried it out, hopefully, then we will ask more informed questions.
Mark, is it the same thing with using E-mini futures? I asked about XSP earlier, basically trying to limit capital allocation. Is it the same thing, just not as liquid?
E-minis, you're not going to get daily expiries. I mean, ES you will, but the commissions are more. So it doesn't like you're using an instrument that's half the size. So you're collecting half the credit and paying twice as much commissions.
Okay.
So I wouldn't do that. And then like, I honestly think I would just steer away from that because you're getting the tax advantage on SPX anyway. So there's no reason for that. And I feel like I would just be misadvising people that would get tempted to do stuff naked instead of using a spread if you were touching E-minis.
Cool.
So I would just say, yeah, avoid the E-minis. And then I've done some stuff too on like Qs and SPY. I would also say slippery slope. I mean, if you're on a commission-free broker, you can kind of touch them, but it's just like not fun getting assigned. And also like you can just get assigned from someone fat fingering their trade. And then all of a sudden you're like, and I always mess around with stuff, but I actually got assigned once on the Qs. And if you look into it legally, they can decide to exercise their basically option up until 5:30 on the Qs, which is kind of bizarre, but it happened on a big tech earnings day, obviously. And then I got assigned after the close and I was like, what, how is this possible? So they can assign you on like a short call if Apple has good earnings, which is ridiculous. I don't know who lobbied that in, but SPX spreads, it works, do it. It's liquid. The fees are small. It's the best thing out there. And then, yeah, I was like, they're all pretty good. I do some taste trade on my phone. So like if you're all on your phone, I'd recommend that's pretty good because Interactive's UI is atrocious. It's like almost unusable.
Okay, wow.
So are you guys going to trade any of these? Which ones did you like the most, or which ones don't make sense to you? I guess we can go back to the screen here.
Yeah. I've
So
identified
these
3.
calendars are all kind of the same.
Right.
So you can kind of choose whichever one. I know we only talked about the Monday one, but it's like they're all the same thing. They're just different durations.
Yeah.
But so we had the no stop tight spread. We had the open trade. We had the Friday expiry. We had the trend following in power hour, and then we had the calendar. Were there any of these that didn't make sense, or any of these that you guys really liked and want to hear more information about? Or
Well, I don't
Yeah, I
mind.
guess.
Sorry, go ahead.
I guess. Sorry, maybe the Iron Condor one. It's probably the most popular.
the
Yes,
245 one or the open one?
the open one. Sorry.
Yeah. So this one, what was your
I
question?
mean, I don't know. Sorry. I mean, I missed the beginning. You started your presentation. I'm sorry again, but I don't know if you covered all this. But have you kind of gone through the whole process here? Because I see like, VIX maximum 0%. Like, what does that mean? Are you saying that the VIX has to be no movement at open?
Yeah. So the theory.
Do you mind going through one, like just going through it? Let's say.
Yeah. So the theory behind this trade is that we're actually delta neutral because the skew is more on the put side. So like if we trend up 10 points, we're still neutral basically, rather than collecting the same on each side because the put outperforms the call. And then the reason I have this VIX filter is there's rich implied volatility overnight because of the fact that it is a liquid. So if the VIX closes at 4:15 and opens up at 9:30 the next day, and this is also the open value. It's not when the VIX opens at like 2:15 in the morning or whatever it opens. It's what opens at the market open. So if that rich implied volatility risk premium overnight did not come out, so the VIX opened up from the day, it closed at 20, it opened up at 21. Whereas if it closed at 20 and opened up at 18, that volatility came out overnight. So when that volatility doesn't come out overnight, there's going to be an abundance of buyers of protection at the open because people need to close out their orders or they need to buy protection because something happened overnight to their long portfolio. So therefore, if we sell premium when the VIX opens up, we get all of the risk premium from the prior night that didn't come out. And we get some liquidity benefits from them being more, buyers than sellers, basically. So we compensate for that. And it doesn't work very well. It's like a 5%. It works like 1/5 as well if we flip the VIX filter, basically. So this is just the VIX closes at 4:15 every day. And then what does the VIX open at 9:30? And if it opened up, we're just going to trade this. And then also in regards to this, you could enter this as a condor. I recommend entering each leg separately and always enter in both legs because they do have a big stop loss. So you want that other side to offset it. So even though these are 4x stop loss, it's actually 2 because you're not going to get a double stop on both sides. I've looked through all 1,700 trades. Happens about once a year. So it sucks when that happens, but it happens. Manage each leg separately.
When you say separately, you mean the spread, the put spread and the call spread, right? But not the 4 legs.
Correct. So you're managing the call spread, you're managing the put spread. And the reason you do that is because if you're shopping an order on a 2-legged order, let's say you should get 10 cents of slippage. But if you add another leg, you may get 15 or 20, but that other leg is like now to 1 delta and worth 10 cents. So not only are you losing the 10 cents of that untested side that's going to expire in an hour, you're also paying $10 more commission. Right. And the edge on this is only $28 a trade. So you're basically giving up half your profit from just executing on something that does not make sense to execute.
Now, I had always heard that the more legs you present for fills, the better the fill you would get, but it doesn't apply in this case?
I would say that is potentially true, but not on stop loss. You know what I'm
Okay.
saying?
You're
So
right.
like if I was presenting a four-legged order for a profit take that was resting within the market for an inordinate amount of time, a butterfly or whatever that may be, I would think that I would actually get a better fill.
Okay.
But if the market is moving fast in one direction with a bunch of gamma and zero DT, there's absolutely no way you're going to get a better fill
Got it.
because you have so much gamma exposure and risk on that option that a stop loss, you're not going to do it. But for a profit take, yeah.
So you call this one the 932 all in, 932. Okay.
All in it open. Like we're pushing our chips in. You know what I'm saying?
Yeah, yeah. And you would conceivably do this daily. Okay, all the information is there. That's great.
Yeah. And it's never daily because of the VIX filter, but
Right.
again, contrarian wise, it's like the VIX opens up and down half the time. So like some weeks you may never put it on. Like this week, only Monday has had the VIX up, which is kind of crazy because the volatility has been high, but
Yeah.
volatility has obviously been coming down since Monday.
So when you say the VIX, are you looking at the actual VIX?
Yeah, the index. I mean, the futures are like the parity between them is basis points, kind of. So
Right.
I don't think it would really matter.
Okay.
Honestly, and I'll tell you right now, it's like if you accidentally put this on when the VIX was down 10 basis points, it's probably not, you know, like it's not a line that divides it in half. It's just like if the VIX is down by 2%, yeah, it's not a good trade.
Okay.
Yeah.
Would you mind going over one calendar? Just pick any one.
Yeah.
Yeah.
And then I like the kind of Monday because I think that a little longer out in time with daily expirations is not as accurate for calendars.
Right.
So a thing to think about calendars is, and this is kind of like a mind blowing concept to some people if you've ever watched videos, but calendars are short theta, not short vega, and short duration expirations, which I know sounds kind of ridiculous, but to kind of explain this to you, so if we were to gap down a lot or something, like all of a sudden this 15 delta option would then be in the money. Okay. So the bid ask spread is always going to be constrained by the SIBO to 5% of the bid ask. So if we gapped down by 200 points and all of a sudden we were 200 points in the money, we know that that option is going to be worth at least $200. So even though Vega 5x'd or whatever, some ridiculous amount it was, all of a sudden the amount we're paying for that option 10x'd. So the drag from the bid ask spread going up 10x offset all of the benefit of the Vega going up 5 times. So with short duration calendars, even though if you model on the graph it is, that's not how it works in real life because we have to get in and out of the position. And also in regards to that is you can end up paying more for the debit on these than you can end up selling it for more than the debit you paid, again, because of the bid ask. So that's like a whole in the money thing. So I can't really show you this on a back test, but it's true. So just kind of keep in mind, if your calendar goes more than like 30 points in the money, you should just close it out. That's like a pretty good risk management rule of thumb. But basically what we're doing here is at the close of day on Monday, we are selling 15 delta on each side with the Wednesday expiration. And then we have the Friday expiration as our long at the same strike. These will be a debit trade, so they'll be very capital efficient. It ends up being about $1,500 per spread is kind of what is typical of this. And I have a profit target here of 40%. It like never happens. You're always exiting at 10 a.m. basically. But the theory behind this is basically we are just going to let the theta decay. And this is a nice pairing with zero DT trades, because in zero DT, if we get quick moves, we can get stopped out, which means we lose money on credit trades. But if we get quick moves up and down, this is like the perfect scenario for a calendar. The other thing I'll also say with calendars is I don't know what's going on with short duration calendars. Like these back test match, this data is real. It makes no sense why these make money. And like the example I can kind of give of this is we can see some weird ones here. Let me see if I can find a few. Okay, so this one right here, we entered the trade on Monday at 51.72 and we exited the trade on Wednesday at 51.80 and we lost money, which makes no sense. Yeah, you know what I'm saying? So these are just weird. And then it's like there could be like some bond auction that happened or something popped up right thing in the beginning of the market that like doesn't really make sense on these trades. I mean, a small down move is always the best case scenario for these things. But if volatility was like really low Monday at the close and even if the market went up, volatility could have picked up for these durations because it's not even based on the VIX. It's based on the Wednesday and Friday expiration of SPX, and the VIX is a 30-day price slice of everything. So the main thing I want to tell people with this is like, this works. The data matches. I've ran these. They could do it, but don't run them big, even though they're capital efficient, because you still do have gap risk, and that gap risk is from the bid ask. Okay. It's not from that. And then these will never make sense why you make money because there's like no metric for what the vol is of Wednesdays versus Fridays expiration, and then skip FOMC days. Like if there's something like that going on, but this thing works and like you just plug away at it. It takes no maintenance. It's like an old dog. It's in your house. It lets you know when it needs to go to the bathroom. It's happy to see you whenever you come home, and it just makes money.
This is so cool. I feel like just doing 5 of them.
Yeah. And the thing about these too is like they get small wins and then they get a big loss. So like you like don't, because the thing is, this is the widowmaker for small accounts because you'll run this in a 1 lot, 2 lot, and then like you could easily run this in like a 10 lot, and all of a sudden you're making like $1,000 a week, like not even thinking about it for like a month in a row on a 50 grand account. You're like, I'm a genius.
Right.
I'm starting a hedge fund. And then something like Monday happens and you lost like 10 grand because you were just like massively sized and had no idea.
No, I personally didn't mean 5 calendars. I meant 5 of your strategies. I'm going to do. I'll start with 3. And then,
and like I tried to really sit there and think, I was like, okay, how do I not misguide people? And like, this is the one that's going to get people in trouble because it doesn't make sense. Like the market could be doing terrible stuff, or like vol is just suppressed for some weird thing on Mondays and Wednesdays or something. But like, this is a trade that will get you in trouble. And the other trade is that Friday trade. Like, but if you run both of these at a small duration, like this pairs really well with the Friday trade, because if that volatility doesn't come out over the weekend, this is going to do really well because you're going to sell it when it's super rich. And if that volatility does come out over the weekend, you're basically already safe and you could deploy this trade. So this I kind of view as like a 2-headed monster. And like all of your risk and loss on that weekend trade is going to happen from something funky happening over the weekend.
Mark, I think Andrew Wright, who's a total newbie, very young, and a newbie, has a question that he's asking me. And I said, no, pose it to Mark.
I've been really bad at reading the chat. I'm sorry. I didn't see there's 5 things.
He posted it to me privately. And I said, no, ask Mark. Andrew.
So I was wondering if you went back to Power Hour, if I was just wondering if I set something up right.
Do you want to see the strategy or you just have a question?
I just have, so kind of going into the initial setup of it. So you're buying is it a 5 delta call, or sorry, selling a 5 delta put?
That's the Friday trade, but yes.
Okay, so that's not this one then.
Do you want to see that
Power Hour one? It's different.
So this is the Power Hour trade, is the EMA trade or the no stop tight condor. And then there's also the overnight weekend trade 5 delta.
So I think I was looking at this one maybe.
Okay, yeah. So this I put on at 9:45. It doesn't really matter that much. It does do better putting it on in the morning. So the dealers basically start to suppress their vol at Friday when nothing breaks. And you can see this phenomenon. Like if you look at the move over the weekend and like the move on Fridays, it's suppressed. It's either really, really bad or basically non-existent. That's Fridays and Mondays. So you can put it on at different times, but you just collect more credit when you put it on 9:45 and the volatility is understated and it tests better. So I put it on at the open basically.
So that's a 5 delta call and then
it's a 5 delta, put. So see how this,
sorry, yeah,
it's
50 delta put.
And we're selling this because of the skew, that 5 delta put.
Okay.
Yeah.
And the width is that your question, Andrew? How wide? Where's long? Okay.
Yeah. So the width is 50 wide. And the reason we do this is to basically like, if something were to happen, like basically think of this as like we're buying a hedge. You know what I'm saying? Because like if you look here, it's relatively expensive. It's, you know, $2, $2, $3. It's a pretty expensive option, but the volatility is so rich over the weekend that we're kind of okay with this. So this is like, we're buying the put there as protection and buying power cap more than we're doing it because it's efficient. And then if it's 50 wide, do you know how much buying power that would take?
5,000. Is it?
Perfect. Yeah. So this uses 5,000 of buying power a week. Technically, it used 10,000 because you'd have 2 on at once. But this is one trade where if you want, you should buy it back on Friday for 5 cents.
Okay. Thank you.
Yeah. So you ready to start print money using this or what?
I mean, I want to. It's been. I want to. It'd be fun to quit my day job and trade. Can't do that quite yet. So
yeah, one thing I will say is when I started running a hedge fund, I thought it was going to be trading, and it ended up being a lot more marketing and vlogging and like legal work than it ended up being trading. So like I actually finally got to the point where I have enough capital where I can actually just like chill and trade for a little bit. But I've actually been trading very, very, very little, running a hedge fund actually.
yeah.
So this is pretty automated for you then.
Yeah. I mean, that's like, I think everyone kind of gets that, and that's where everything's going. And like I said, it's like, I don't doubt that there's talented people, like 7-foot people that are good at basketball. But if we want to create income for like everyone as retail traders or for someone to appeal to it, like that's what we should do. And it's like, you know, we're all going to age, like your mind's going to get less sharp. So automating it is just going to be better. And then mentally, it's like you're also being very kind to yourself and opening up your bandwidth for like everyone is in your life and like things you can do when you're automated and data driven. Cause like, you know, what I say is like, I just want to get what I bought, even if that's a loss. You know what I'm saying? It's like, if it matches the back test, like it's a win for me. And like mentally, that just makes it like so easy. It's like I was like hanging out with my buddies on Monday and they're like, oh dude, like what happened? And I was just like, nothing. you know what I'm saying? And it's like that's kind of the response that you want. And I was actually like doing this exercise of like a self-development thing, and it was just kind of like, what story do you tell yourself that you use to basically like stroke your ego and feel important? And then I kind of thought about that, and like when I first started trading, I was never stressed. I never found it stressful. And recently I'd started to find it very stressful, but then I started to think about it, and I'd tell people what I do and they go, oh my God, that's so much responsibility. You have other people's money. It's like, I don't know how you do it. You must be really stressed out. And I started to agree with them. I was like, yeah, it is. It's a lot of responsibility. And when I started saying that, I started getting stressed. It happened slowly over months and months, but it's like, I didn't realize that till probably 6 months down the road. So it's just, you know, we got to be careful with the stories that we tell us. And the main thing with that is like, you want to be the narrative and the person that writes your story, and you want to be your own cheerleader. So like having the time to like write this out and be like, what am I going to do? Why am I going to do it? And then like, it's a success if I executed it for 90 days and I learned, hopefully you should make money. I think I put you on the right path for that, rather than like, I want to make 20%, because 20% is the outcome. But what you do on a day-to-day basis is completely different. So like what I like to say is like, make your goals as big as you want. Make $10 million, start a hedge fund, that can be all day. But like make your rules on a day-to-day basis for being happy easy, which is like, I tracked my trades, I wrote what I did well, and I wrote what I did not do well, and then it matched the back test and I checked it. It's like, that's the day-to-day that makes you happy, and you can still get to that $10 million goal. And then it's like, if you got to that $10 million goal on July of 26 instead of July of 25, was that a failure? You know what I'm saying?
Mark, I'm going to, what's the difference between average per trade and average winner?
So average per trade is the expectancy or expected return. Okay. So if you think about this, the average winner would be like what we win. So 91% of the time we average $89. Okay. You know what I'm saying? Yeah. And then 8% of the time we average minus 476. But you can see here that even though our average winner is $89, when the volatility is high, we made $250. Right. Or when the volatility was high, we lost $774. So the way to think of this average per trade is like, if we have a 43% capture rate, which means if we sell $1, we keep 43 cents of it. Mm-hmm. This basically means that like our average trade is around $100. So we should expect to collect about $100 in premium over time on this trade, which means that, and this also mentally can be a good thing. It's just like every time you put this trade in, regardless of what the result is, and you put your stop. And also I don't know if we went over this. I want to remind everyone this does still have a stop loss. So like everyone take note this, we still are defining our risk on this. You know what I'm saying? And if you wanted to use some discretion of like, it was 350 on Tuesday and you're at a 450% stop, you could obviously take it off because there's gap risk overnight. So you could kind of do that too. I wouldn't do it because I just size it small enough to where it wouldn't matter. But that's like the way to think of it is it's like every Friday in the morning when you put this on, you just put $40 in your pocket. And like, I'm a big like mental purpose. It's like, if you were going to start doing this trade, like go to the bank, get $40 out, put it on like a little notebook with a pencil. And every day on Friday, you write your strike, what you put on it, and then put your $40 in your booklet and close it. And then next Friday, you take your $40 bookmark out with 220s and you write your train down again. Because that's what you're doing every time. Is you're making $40 on every trade over the long term. You know what I'm saying? And then after you do this for 90 days, you should like take your girlfriend out to a nice date and thank SPX for it.
The stop loss 500% is 500% of the credit received.
It's a net, so it's a $500 loss. So if you sold $100, it would be a $600 buy order.
Got it.
So it's a $500 loss.
Got it.
Yeah.
Yeah. It's wonderful. Should we let him go now, guys? Gals?
Sure. Yeah, I could ask a question though.
Go ahead. If Mark's staying, I'm staying.
So on this one, you're at a 5 delta, so you're short your put 50 points above that, correct? Is that what you're saying?
50 points below, but yes. Yeah. So you're short delta put, and then you're buying a long put 50 points.
Oh, sorry. Okay, so
delta.
You're 50 below whatever the market is at 945.
No, you're 50 below you're selling the 5 delta, whatever it is, at 945 at the 7-day duration, and then you're buying a long option to cap your buying power and limit your risk $50 below that 5 delta.
Okay, well, sorry, that's what I meant. I think you just said it first.
I think here I can kind of show you an example. So like, for example, on April 26th, you sold a 48.70 and you bought a 48.20.
Okay.
So yeah, vertical spread. Let's
Right,
see.
right.
Let's see too. So yeah, I mean, there's some. We could even look at it here, but there's some great winning streaks. To give you, so like, let's see one when you look really smart. Yeah. So on this one from October 28th of 2022 until April 28th of 2023, you only had one loss. So you'd be feeling pretty smart
Right.
running this one from the, so you went 6 months with only one loss on this.
And this is your bot doing this as one.
Yeah. I mean, I don't run this in the fund just because I don't think it's, I'm a zero DT guy. I've pitched no overnight risk. But I kind of made these particularly for you guys that if you had a $50,000 portfolio and you're trying to make 30% with a 10% drawdown, I think this would be the way that I would go about doing it. Yeah.
Excellent.
Thank you.
I'm all.
Works.
Any other questions? We should really let him go, and we'll definitely have him back again. I'd like to just talk to him every month.
Yeah, I'm always here to be a sounding board, but I'd really encourage you guys to keep track of what you're doing and let me know how it goes when you come back,
Yeah. So who's in? I'm in.
I'm gonna give it a shot.
Yeah, yeah.
Yep.
3 months, 90 days.
Fauzi, are you going with the weekly one or are you going with the daily one?
I'm gonna do the Friday 5 Delta, the
Yep.
Monday calendar, and I'll try the 130 EMA, 130 to 230, that one. I'm not sure about all in because you have to check the VIX and this and that, but those seem pretty
Yeah, that's pretty. It's easy.
yeah,
And you get to
easy.
do one tomorrow. Actually, you could do 2 tomorrow, which is always fun.
Yeah, yeah. The
I'm
EMA
gonna get Mark to run his bots on my account so he can do them all. A lot easier that way, brother.
Yeah.
We'll get there. I think after you double and triple your account, then we can do the bots. Thank you so much, Mark. That was such a delight.
Thanks very much.
Thank you for your generosity of time. And we'll let you go. The rest of us can stay if you want to talk some more, but we should let Mark go so that he'll readily come again.
Of course.
And definitely will, I'll just call Tom and I'll do the Zoom. Because he wanted to come today. Unfortunately, he didn't, but that's okay because then we got more time with Mark.
Perfect. Well, I will talk to you guys later and enjoy your evening.
Thank you. Thank you very much.
Thank you.
Thanks.
Yeah.
Thank you, Mark.
Bye.
So if you guys want to stay, yeah, what did you think?
It's pretty interesting. That's for sure. The bot. I mean, I had looked at the bots, but to be honest, never spent any time investigating them. To be honest, I did try writing them, but oof.
Like the calendar, you don't really need a bot. The Friday 5 Delta, you don't really need a bot.
Yeah, but this is easy with all you retired people that have nothing to do all day.
No, that is not true. That is not true.
Us working folk.
Yeah.
It's a
Well,
bit more
remember
challenging.
he said, all you have to do is put in a good till canceled order, right?
Yeah,
For the loss.
You gotta even find the time just to do that.
Come on, he said it takes the Friday 5 Delta. Come on, Mike, that takes like 5 minutes.
Okay, fine, I'll do it. I'll do it tomorrow, for God's sake. I'll do 20 of them. Happy now?
Who's in with me?
I'll do the 5 Delta tomorrow.
Okay. And
I'll do it
we
tomorrow.
can even make a little chat.
I gotta make sure I understand it because I think I was looking at his stuff and I wasn't quite. So
Well, go
I
ahead.
guess
If you want to share your platform, we could just try to emulate. If today were Friday, what would we have done? Or
okay.
there's the overnight one. There is the calendar. you,
Hold on. I wouldn't mind trying the
Mhm.
the 5 delta.
Kevin, are you there? You're not talking much.
He's an old man. He probably fell asleep. Yeah, where is he? What the hell?
I don't know. He's got his mic off. Hello, Kevin.
Classic.
He might be doing
Oh,
something.
Andrew obviously went to bed, or his mom called him.
No.
Carolyn,
And
on the other
are you
hand, they
there?
took bike to
No,
the road.
he left his chair.
He's got his mom.
I
His
definitely
mom
want
called
to,
him.
I definitely
Go
want
ahead.
to trade these. My trading, I go in and out of trading just depending on what else happens in life. Like I go months without trading a thing, and then I come back to it for a couple weeks. And so this could be a way to kind of get me into like a regular schedule.
Yeah.
You know, if I just said, oh,